Hello, I'm Paul Doocy, and I'm with CP Capital U.S., a New York headquartered real estate investment firm. And historically, we've been a firm that's brought overseas capital into the U.S. to make U.S. real estate investments. A little bit about the name, simply because it's a new one. We have had German ownership historically. In the past year, we've gone through a process of bringing on some new strategic partners. We still have German ownership, but they are now in the minority, and the CP Capital name relates more to a Canadian firm and a Seattle firm that have combined together to now be the majority owner in our company. The team is the same, and many of us have been together for 20 or more years. And then our strategies are really the same as they've been, and we'll talk further about those on this call. Yeah, their appeal for investing in the U.S. in residential is a demographic-driven one. We've had German investors for more than 30 years, and recalling going over presentations with them, there was always a focus on a population growth graph. And that graph probably showed Japan going across and declining, and Europe being flat, and the U.S. having growth. And I know that was a big driver in their thoughts about the appeal of U.S. residential, just the demand driven factor. And then more specifically, why certain cities or certain states. You could certainly show a chart that says the top growth markets might be some of the major Texas cities, or Phoenix, or Orlando, cities like that across the South. That's been true. That continues to be true, and that's also another factor that's a little unique here. That would be something that the Germans would catch on to, which is simply the migration here. That people are moving. They're moving for jobs. They're moving to be in a warmer climate. They're moving for a variety of reasons, and then tying that into residential and apartments in particular, that matches well with people saying, well, I'm really not going to buy a house right now. I'm going to continue to be moving. It's easy to be moving from someplace where I have a 1-year lease, and at the end of that time, I can be moving on to another market and being promoted in my job by moving to a different city. So I think those factors they saw as unique, just the demographics, both in terms of the population growth and in terms of migration within the U.S. to different growth cities. So our experience tells me, I know that they're investing in apartments both as value add opportunities where it's somewhat older property that can be renovated. We've done that, and we have investors that have been happy with that. And then much of what we do is opportunistic, and so to the point where it's development, ground up development, that's most of what we focus on. So I know that's part of the activity. We look at single family for rent. We've done projects that are townhouse projects that are for rent. So in terms of this more recent push on the single family for rent, I don't know of any particular German groups that are big into that, but that very well could be. I think, again, having talked about the demand drivers and why they would see residential appealing in the U.S. and why rental in particular would be appealing, I think they get all that. So that's all drivers for why they would be active in all these aspects of multifamily rental. And we know there are groups that are buying, that are big groups from Germany that are buying apartments with people here, and there are funds here like ours that are buying apartments. I think the development of apartments was something, you know, kind of unique, and we can talk some more about why that was appealing in particular. Yeah, so across the South is easy to say. You know, we say the growth markets. The you know, the top 6 largest markets, like a Los Angeles or San Francisco or New York, we would say we look at suburban properties associated with them, but really at the top of the list are these markets that are largely across the South. The Southeast as a region maybe being at the top of our list, having had great experiences with Tampa and Orlando and in Atlanta, the South Florida markets, the Carolinas, so all of those, but wouldn't exclude by any means the major Texas markets where we were always active there. Phoenix, Denver is one that moves a little north, but that's been a great pocket for us. We've been in some other markets for you know, niche reasons, because we've had partners who are based somewhere and we got comfortable with them. But if we just list where we want to be, it's these growth markets that are largely across the South. Yeah, so that's our focus and has been largely. While we've done some value add acquisitions, and those mainly came after the financial crisis. So in 2009, if you go through the last 27 years, we've done ground up apartment development joint ventures every single year except 2009. And fortunately, we had capital and we were buying projects that probably other people shouldn't have been selling at that time. So they were great opportunities. But by 2010, we were active with development again. We do it on a basis where we're teaming up with local regional developers who are experts in those markets. And we're looking for that. We need a partner who knows what they're doing, who can execute, and ultimately deliver the product and lease it up, and then we're looking typically to sell it. So it's an equation that works because you're looking for a higher return. It's a risk-adjusted return that makes sense. You're creating value, and again, if you work through all the factors that you could on the due diligence side and make sure you're teamed up with the right people, then it's a strategy that we definitely think makes sense and has proven to perform well. You're building something at a cost that's less than what someone will pay for it once it's stabilized. You've taken the risk, and it's appealing to our investors, and it has made sense consistently over the last 30 years. So it's more high risk because we're really starting with a piece of dirt, or knocking something down and then building apartments. But we're focused on this new ground up development. So you have to, the developer has got to get it through a process where it's ready to go, and then we're typically coming in along with a construction lender, and we're getting it built, getting it leased up, and then sold. So there's a risk in the construction. There's always problems that can occur. There's timing as far as the lease up. You may start the project and the market's great, and there may be some economic factor throughout the U.S. or the world that causes a disruption, and when you're leasing, you don't have as good a situation as you thought you would. So there's risk. you try and mitigate it again by finding the right partners, the right team of people that's involved in the project. So it's higher risk. You're looking for a higher return. You're not trying to get the same return that someone does when they're buying a stabilized core asset. You're looking to get higher. I think you can do things that limit the risk in terms of, again, having the right team, but also even on the construction loan side today, these loans that we're involved with tend to be 60-65% construction loans, loan to cost, as opposed to much higher ones at previous times. And so there's a little more comfort there, a little risk mitigation in terms of how much leverage you're using. But the leverage is part of the equation that helps drive the overall return. So higher risk, higher return, but managing the risk in a whole variety of ways with the structure and the team. Look, the only comment in the midst of what's going on right now and what's gone on since the onset of the pandemic, I think there are some sort of crazy numbers in terms of rent growth, the lease up velocity at projects, and we've benefited from those. We certainly have. But we've been active with this for 30 years, and our thoughts are more focused on, this has been something that's been consistent. Apartments have been a stable investment category. Coming out of the recession, there were a number of properties that we held and ultimately made a profit on. There were ones that didn't, that we couldn't hold on to. But really, if we look at that whole time period, that's through several cycles, it's a strategy that makes sense in terms of this apartment investment and apartment development. And again, it goes back to the initial comment of the demographics here in the U.S. You could certainly learn more by visiting our website. We are CP Capital U.S.com, and again, outlines our history and the activity in apartment investing in particular that's been our focus. Thanks.